Hello and welcome back to Global Value. In today's video, we're performing a fundamental stock analysis of Star Bulk Carriers Corporation, ticker symbol SBLK. So we're looking at Star Bulk today because this was one of the most popular companies that we looked at in 2022. Star Bulk right now is paying out a dividend yield that's almost 32%. And notably, among companies that pay out a very high dividend yield, Star Bulk is actually owned by one famous value investor, with Howard Marks having about 6% of his US-listed Oaktree Capital Management portfolio in Star Bulk Carriers. So right now, Star Bulk is trading for $20.21 per share. So their stock price is down from when we last covered the business. Over the last year, their stock price is down 2%. Over 5 years, however, Star Bulk Carriers is up at a rate of 12.5% annually. Dating back to when the company was publicly listed nearly 8.5 years ago, however, Star Bulk Carriers is down 66%, so their stock price is down by 2/3. Keep in mind that their average dividend yield over this period would be in addition to this 12% annual decline. So Star Bulk Carriers is trading about $3 above their 52-week low. They're down about $14 from their 52-week high. About 8.5% of the company's shares outstanding are currently sold short, and Star Bulk has about a $2 billion market cap. For more background about the business, Star Bulk Carriers Corporation provides seaborne transportation solutions in the dry bulk sector. The company owns and operates dry bulk carrier vessels, which are used to transport major bulks such as iron ore, coal, grains, bauxite, fertilizers, and steel products. As of December of 2021, the company had a fleet of 128 vessels with an aggregate carrying capacity of 14.1 million deadweight tons. This fleet included 17 Newcastlemax 24 Capesize, 7 Post-Panamax, 41 Kamsarmax, 2 Panamax, 20 Ultramax, and 17 Supramax vessels. The company also provides vessel management services. It generates revenues through voyages that it carries out. Star Bulk Carriers was incorporated in 2006 and is based in Marousi, Greece. So for our fundamental analysis, we are performing the Select 6 analysis, taking a checklist-style approach of 6 standard financial metrics to come to a holistic and beginning understanding of Star Bulk Carriers based off of their business fundamentals. This analysis is an evolving process, so it will continue to improve and get better over time, and it's an opportunity to learn in public. So with that said, let's get right into today's analysis. Starting things off with metric number 1, we want their average return on capital over the last 5 years to be above 14%, and there are 2 major reasons for this. The first is that the average publicly listed business earns about a 7% return on capital, and the second is that over the long run, over the course of decades, a stock is likely to return approximately what its underlying business returns, and these business returns are going to be captured here by return on capital. So by asking for a benchmark of 14% or higher, we can potentially build in some margin of safety for ourselves based off the overall quality of the business being about twice as good as average. So Star Bulk, similar to a lot of its peers, had really low returns on capital from 2017 until 2020. Since the COVID-19 pandemic, however, their returns on capital have skyrocketed pretty recently. In 2021, the company earned about a 20% return on capital, and over their last 12 months, they're earning about 24% returns on capital. These major swings in their return on capital come from the fact that the dry bulk shipping market is a commoditized business. Because of both the heavy nature of the capital investment that's needed for the business and the lag time between demand and when supply is able to come online, as these vessels need to be built, are some of the major contributing factors to why this is an industry that's prone to boom and bust cycles. Right now, it seems like this industry is going through some of the better times that they've had more recently. Even taking the company's recent good times into consideration, over the last 5 fiscal years, Star Bulk is only averaging about a 6.5% return on capital. So those returns are slightly below those of a typical company, meaning that this is going to be an X to start things off here on metric number 1. Next up, for metric number 2, here we're taking a high-level overview of the growth of their business. So we're looking for revenue, net income, and free cash flow growth over the last 5 years. And this metric is going to be all or nothing in nature. Either all 3 of these are going to be up for this to be a check, or if even one of these is down, this entire metric will be an X. So over this period, their revenues are up by nearly 5 times. Their earnings have also gone from being negative in 2017 to they've been quite positive over 2021 as well as their last 12 months. And their free cash flows have also gone from being negative in 2017, 2018, and 2019 to now they've been positive in 2020, 2021, and over their last 12 months as well. So all 3 of these are up, and this is our first check of the day coming in here on metric number 2. It's especially great to see that their free cash flows are up because free cash flow is really the lifeblood of any business, and a business can use its abilities to produce free cash flows to pay dividends, buy back shares, make acquisitions, pay down debt, or reinvest back into the business. So ultimately, a business's abilities to produce free cash flows now and until Judgment Day, discounted back by some reasonable interest rate, is what that business is going to be worth. Great to see such growth here for Star Bulk. Again, this is our first check here on metric number 2. Next up, for metric number 3, here we're taking the perspective of an individual shareholder in the business by looking at Star Bulk on a per share basis. So we're looking for earnings per share growth over the last 5 years. And so we learned in the previous metric that their earnings are up over this period. However, earnings are just the numerator in this earnings per share equation. So we also want to look at what the company has done in terms of their shares outstanding. Unfortunately for existing shareholders in the business, over the last 5 years, Star Bulk has diluted existing shareholders by about half. They've nearly doubled their shares outstanding over this time frame, with this dilution pretty much spaced out between all of these years. So even recently, they've been diluting existing shareholders. However, even with this pretty massive shareholder dilution, the company's earnings are still up at a rate that's faster than their shares outstanding are up. And this means that their earnings per share have actually grown over this period. Again, they were negative in 2017 and they're quite positive today. Star Bulk has produced about $6.30 worth of earnings per share over their last 12 months. So this is another check here on metric number 3. Then metric number 4 is going to be very similar. So here we're looking for free cash flow per share growth over the last 5 years. Again, similar to their earnings, their free cash flows have swung from being negative all the way up until 2019 to now they are quite positive today. And even with their shareholder dilution, they've still managed to grow their free cash flows on a per share basis. So Star Bulk Carriers has produced about $6.29 worth of free cash flow in their most recent 12 months. And this is yet another check here on metric number 4. So far through our first 4 metrics, we have 3 checks and only 1 X for Star Bulk Carriers. Then next up for metric number 5, here we're evaluating how the business utilizes debt. So we don't want to be investing in overly levered businesses because during economic downturns, it's overly levered businesses that are going to be at the greatest risk of poor outcomes. Star Bulk Carriers ended 2021 with $1.1 billion worth of net debt. Since then, they paid this down slightly, and right now they have just over $1 billion worth of net debt. However, over this time frame, when we sum up their free cash flows, the company has only produced about $260 million worth of free cash flow. That's only about a quarter of their net debt position right now, and so this is an X here on metric number 5. However, worth being aware of is that over their last 12 months, the company has performed significantly better than they have over the previous 5 fiscal years, and they produced about $637 million worth of free cash flow over this time. So if these current free cash flows are able to persist and are going to be maintained going forward into the future for the business, then it looks like they'd be very reasonably able to support their debt loads, needing only 2 years worth of free cash flow to pay off all of their net debt. So similar to some of their dry bulk shipping peers, a major part of this business's potential thesis going forward is going to depend on if their currently elevated free cash flows are going to be able to stay up as being more normal for the business going forward, or if these cash flows are going to come back to where they've been at historically over this time, which has not been so hot for the business. Then our 6th and final metric, the big metric of them all, we want their average free cash flow to their total enterprise value to give us a yield that's above 5%. If this is the case, this would potentially give us a slight risk premium to the yield of the 10-year treasury and potentially give us another reason to be interested in Star Bulk Carriers. So we're using their total enterprise value because it takes into account both their market cap and their net debt position, and it's going to give us a perspective of the economic reality of the company that's more similar to as if Star Bulk Carriers were a private business. Right now, they have about a $3.1 billion total enterprise value, and we learned that over the previous 5 years, they've only produced about $260 million worth of net free cash flows, meaning that in an average year, they're only producing about $52 million worth of free cash flow. So when we divide their $52 million of their average free cash flow by their $3.1 billion total enterprise value, that only gives us about a 1.6% average free cash flow to enterprise value yield. So on a historical basis, this is well below the yield of both the 10-year treasury and that 5% benchmark we're ideally looking for. And so this is an X here coming in on metric number 6. Again, worth being aware of though, as we learned in our previous metric, their current free cash flows over their last 12 months are much higher than where they've been at over this time historically. So to get a current free cash flow to enterprise value yield for the business, when we divide their $637 million of their last 12 months of free cash flow by their $3.1 billion total enterprise value, that gives us about a 20.5% current free cash flow to enterprise value yield for the company. So because these numbers are on such opposite ends of that 5% risk premium benchmark we're ideally looking for, it's likely that the economic reality for the company is somewhere in between the two, meaning that it's potentially worthwhile to dig in and learn more about the company. And you'd especially want to work to try to understand if you're going to have some insight into where this business's free cash flows are likely to be in the future and where dry bulk shipping companies potentially stand in some sort of boom and bust market cycle. Please be aware that this is not a buy or sell recommendation of any security, and that this analysis is meant to be holistic in nature. These metrics are simple, but when they're combined together, they can be very powerful. So then as a bonus, here we're looking at Star Bulk Carriers dividend profile. So again, right now Star Bulk has a 32% dividend yield, which is one of the highest yields of any business in the entire stock market. However, people make mistakes all the time by blindly chasing dividends, so it's important to stop and look at the underlying fundamentals of a business and to determine whether their dividend payouts are well supported either by that company's abilities to produce earnings or free cash flows. In the case of Star Bulk, we want their dividends to be supported by their free cash flows, and Star Bulk has only paid out dividends in 2 of these 5 years. They started paying out dividends in 2021. They paid out a very small amount of dividends in 2019, although they quickly shut that down, likely rightly so because the company had pretty negative free cash flows over that time frame. In 2020, the company's free cash flows went positive, and in 2021, they started paying out this pretty massive dividend, which because of their higher, more recent free cash flows is actually supported by their abilities to produce free cash flows, even on a per share basis, despite their shareholder dilution. So due to the inconsistencies in their free cash flows over this period, Star Bulk Carriers' abilities to pay out dividends is really going to depend on where their free cash flows are at and if they're able to maintain positive free cash flows going forward into the future. So although this does look like it's a very high dividend yield right now, this might not be potentially the case going forward for the business, as it looks like the company's abilities to pay out dividends are going to be pegged to their abilities to produce free cash flows. So if you'd want to dig in and learn more about management's potential approach to capital allocation, you could do so by learning more about the company and reading through some of their corporate filings. That will give you more perspective on how management is approaching things like paying out dividends and how they are thinking about issuing new shares into the future as well. Then everything we've discussed so far is important, but there's something missing that in my opinion is the main reason to analyze Star Bulk Carriers, which takes us on to using a discounted cash flow model to come to a potential fair value for the business. So a discounted cash flow model is just like any other model in any other discipline. Its outputs are going to be sensitive to its inputs. So here we're starting with an average of their free cash flows since the COVID-19 pandemic, and we're using historical growth assumptions based off Star Bulk Carriers' abilities to grow these average free cash flows since they become a public business. So these are historical growth assumptions that you need to do your own homework on to determine whether or not these are going to be potentially accurate and applicable going forward to give us a potential baseline estimate of Star Bulk Carriers over the next 20 years. So starting with their average free cash flows and then projecting a growth stage over the next 10 years where their average free cash flow declines at a rate of 4% annually, then using a terminal stage for the 10 years out after that where these free cash flows decline at a rate of 6% annually. If we were seeking a potential 10% rate of return for Star Bulk Carriers, then it looks like a fair value for the business is right around $24.67 per share. Please keep in mind a couple of caveats here. So one is that especially due to the highly cyclical nature of the industry that they're in, which is prone to these boom and bust cycles and has this lag time in terms of when supply comes into the market, which can lead to low capital investments during poor times for the industry and overinvestments in capital during good times for the industry, that those are just among a number of reasons why this might not be potentially accurate for the business going forward. Then two, this discount rate would be including their dividend payouts. So because they have about a 32% dividend yield right now, this return would be based off of their dividend payouts with a declining stock price. So this return would be based off of the difference between those two, assuming that they were able to maintain this high dividend payout ratio, as we would not be doubly counting their dividends in this discount rate going forward. Using these same historical growth assumptions together with these same caveats, it looks like you could reasonably expect about a 13% rate of return going forward for Star Bulk Carriers from today. So please be mindful that this type of analysis is not financial advice. It's not a buy or sell recommendation of any security. And before considering any potential investment decision, please consult with the properly licensed and registered legal and financial professionals. So in summary, Star Bulk Carriers checks the box on 3 out of 6 of our metrics. They're earning average returns on capital that are just slightly below that of a typical business, although they have earned pretty good returns on cap, coming in above 20% in both 2021 and over their last 12 months. Over the last 5 years, their revenues, earnings, and free cash flows have all grown by quite a bit, and they've had very strong growth across the board for their company. However, the business has nearly doubled the amount of shares outstanding that they've issued over this period. Despite that, because of their strong growth, they're still up on their per share metrics. Then on a historical basis, it doesn't look like the business is able to support the amount of debt that the company is using. However, based off their current free cash flows, it looks like they would easily be able to support this debt load. And that was also the case when we were comparing their free cash flows on both a current and an average basis to their enterprise value and looking at the yield that that was giving us in comparison to the yield of the 10-year treasury. That does not look that attractive based on an historical average basis. However, that does look like it would be potentially attractive based off their current free cash flows. So again, much of a potential investment thesis around this business is going to be around where their free cash flows are going to be at in 5 or 10 years, and if Star Bulk can maintain their high levels of free cash flow going forward into the future. Then looking at the company's dividend profile, because of how their free cash flows have bounced around and been sporadic over the past 5 years, it looks like they're pegging their dividend payouts to their free cash flows, which is likely good for investors in the business if you're interested in them for their potential abilities to pay out dividends, as it looks like when they're bringing in large amounts of free cash flow that they'll continue paying out a very high dividend yield. However, that's likely not to be the case if they see a reversal in their free cash flows and if those trend back to where they've been at on a more historical basis. Then finally, performing a discounted cash flow analysis of Star Bulk. If you've done the work and you believe those historical growth assumptions for the business, then it looks like starting with their average free cash flow since the COVID-19 pandemic, from today's prices, you could reasonably expect about a 13% rate of return going forward for the business. Again, there are a lot of caveats attached with that, and that this rate of return would be including their dividend yield. So if they maintain this high dividend yield going forward, then it looks like the company's stock price would be continuing to decline. However, you'd likely be able to expect that the difference between that dividend yield and their stock price decline would still be about 13% if you've done the work on those historical assumptions. Because of some of the variability here, it's worth reiterating that this type of analysis is not financial advice, it's not a buy or sell recommendation of any security, and before considering any potential investment decision, please consult with your financial advisor. This analysis instead serves as a beginning and holistic understanding to help you determine whether it's worth your time and energy to dig in and learn more about Star Bulk Carriers. One resource that will definitely help you stay up to speed with what's going on in the market and help you learn more about the business is Seeking Alpha. Checking out Seeking Alpha directly supports the channel as I'm part of their affiliate program. So most of you probably know Seeking Alpha as a source of community-written articles on different stocks. But over the past little while, they've actually become a lot more than that with their new offering, which is Seeking Alpha Premium. Premium has a number of different features where you can track buy, hold, and sell ratings on your favorite stocks. These ratings are from the Seeking Alpha community, Wall Street analysts, and Seeking Alpha's algorithm. You can see earnings call transcripts, investor presentations, SEC filings, and press releases all in one place. You can add your own margin of safety targets and get alerts for when your favorite stocks hit that level. You can get unlimited access to Seeking Alpha articles, and you can tailor your reading experience based on the type of investor you are. You can get 10 years of financial data on any stock to help you with your analysis. You can also import your portfolio into your Seeking Alpha dashboard to make researching easier. And if that didn't convince you, the best thing is that an annual plan is only $99. That's only 27 cents per day through my referral link down in the description below. Normally, premium is $239, but they are currently running a general offer for $119. But if you use my link, it's only $99. So check it out if you're interested. So as a value investor, you're ultimately trying to conduct your research as if you're going to own 100% of a business, and you can truly understand the ins and outs of that company and understand what's important and what's not important, ultimately coming to the underlying essence of that business. Through this deeper research, you'll learn more about the qualitative and the quantitative aspects of Star Bulk Carriers. You'll also likely be able to determine for yourself what a reasonably appropriate intrinsic value for the company will be. So with that said, that's it for today's fundamental stock analysis of Star Bulk Carriers Corp, ticker symbol SBLK. Again, we looked at the business in part because of its very high dividend yield. It's one of the most popular businesses that we looked at in 2022, and because Howard Marks has about 6% of his US listed portfolio invested in the company as of his most recent filings. So if you learned something or if you enjoyed today's video, please be sure to like the video, subscribe to the channel for more stock analysis videos, and comment down below what business you want me to take a look at next time. Thanks for learning about Star Bulk Carriers with me, and have a great day.